Hi everyone, I'm Melissa from eXp Realty and we have Gary from the bank.
Yes.
Gary's a senior mortgage specialist and we've covered all these topics so far. So we've covered income planning with your employment, down payment, and self-employed or business owner. These are our first 3 episodes, and now is our final episode on something you may know or may not know: portable mortgages and assumable mortgages. So Gary, tell us, what does that mean, portable and assumable?
So portable mortgage, it's about, we have a lot of questions about like, can you port your mortgage? People will be asking that question. The reason for that, interest rate is really, really high right now.
Excuse me, sorry. What does a portable mean?
Portable, it's from here to here.
Yes. So for example, you're selling your house, sell at house A, and then you're gonna buy B. You're moving this mortgage from here to A to B without the penalty and keeping the same rate.
Yes, that's very, very important, because when you actually keep the same rate, especially right now, the interest rate is over 5%. When you actually look back in your interest rate, you might be only still paying 2.79%. In the previous days, right? So you might still be able to buy the property that you want right now when the market is slower, okay? And then when not everyone is overbidding. Is there still overbidding happening right now?
If you price it really low, like recently I saw a property in Burnaby, they're pricing like 10% below BC assessment. In those cases, you will still see multiple, but you know, it's like a seller's strategy. You don't find anything selling below BC assessment, but if you're pricing 10% below the BC assessment, then definitely you still get buyers. But it's a seller's strategy to create excitement and urgency. They want to group everybody and then perhaps overbid, right? So this is a kind of you still see it on very well priced properties.
Okay, so is it easier for clients to actually find property nowadays?
You know, the thing is, we still have low inventory,
okay,
right? Very interesting thing is a lot of sellers, they have holding power. So for example, if they secure the rate just last year or the beginning of this year, you know, they don't care if the market interest rate increase because they already locked in a good rate.
Yeah.
So they have holding power. So, but the group of sellers that might be interested in selling or more urgent to sell are variable mortgage sellers. Right now, suddenly their interest rate has gone up, their payments have gone up, then they're more urgent. They finally realize, oh my God, my payments went up like $1,000.
Yes.
If your income didn't increase, but your mortgage payments increase, then you may want to sell that property urgently. So we haven't seen that yet, but you know, slowly I think, you know, this will happen. It will trigger about 15 to 20% of the mortgages. So, you know, if you don't have holding power, you know, opportunity may come for the buyer, and that's why it's important to get pre-qualified and pre-approved.
And the portable mortgage that we were talking about, it's very important. Check your mortgage interest rate right now. Just look into the statement. It will usually tell you what's your mortgage interest rate and when is your maturity date. So maturity date may be like 2 years, 3 years later. It might be 2025, 2026. You might still be able to enjoy the same interest rate even though you're purchasing a new property.
Yes, very important. So another thing is, now this is porting a mortgage from A to B. There's something else I've heard recently. It's called assumable mortgage. So assumable mortgage is, for example, a seller, they have a good rate. For example, they got it maybe last year or a couple years ago, it's like 2 point something. It's still better than the current rate from the bank, which is 5 point something.
That's correct.
But you told me earlier, a lot of time the bank don't like to offer that. And why is that, Gary?
Oh, assumable mortgage, because there's a lot more between, I would say, privacy between the sellers and the buyers, because they might actually get a really good rate, but however the seller, they sell the property, they might not be able to release all those information to you, and then it will be very trouble when you're actually trying to get those information, because you're be asking, it's if you really want to assume the mortgage from the seller, then you'll be asking them for a mortgage statement. Will they want to provide you? It can be very difficult.
Right.
Yeah.
So it really depends on if the seller is willing to offer.
Use that as a feature, I would say. Yeah.
So it's not always so definitely as a buyer, I would not, assume that the seller would want to offer the assumable mortgage. I would, go through the steps, right? Income planning, make sure you have enough down payment, make sure you have all your paperwork.
File your taxes
and get pre-qualified. It's more important to be qualified on your own rather than depend on the assumable mortgage.
We're going to talk a little bit more about penalty.
Oh, right. Yes. Penalty.
So mortgage penalty can be very expensive when you're actually selling your property. So there's two types of penalty that you're actually getting. Usually it's either the 3 months interest or the interest rate differential. So if you're in a variable rate term, most likely every bank might be a little bit different. Most likely you're actually getting charged for the 3 months interest. Okay, so that's, I would say, like, it's the minimal that you get charged for a mortgage penalty. So usually people who goes for variable rate mortgage because they might want to sell the property, like they have an unknown timeline, they don't know when they're going to sell the property, but eventually they will be selling it. So they want to keep the penalty amount really, really low. Okay, but sometimes when you're actually when you're living in the home and then you like the house and you're going to live it for a very, very long time, when the interest rate is low, you want to lock in for the longest term. Let's say you get 2.49 for 5 years term. In that sense, then you're actually locked in as a fixed rate mortgage. A fixed rate mortgage, there's two types of penalty. Either you actually get charged for the 3 months interest or the interest rate differential. Okay, so interest rate differential, basically they're charging you the interest difference because with the current mortgage rate compared to the mortgage interest rate that you get before. Okay, so they charge you the interest rate differential from there. So that can be very expensive, but everyone's situation, again, is different. So feel free to contact me or Melissa.
Yes, so make sure you check with your bank about the penalty, all the information.
Yes.
So we are here to help you. If you have any questions, you can comment below, or if you want to see a new episode, let us know. Comment below, like, subscribe, and share to your family and friends.
Thank
you
you
for watching.